Welcome to the Financial Independence Channel, where we help you turn your money dreams into a reality, or at least try our best to. And what better way to start your journey towards financial freedom than by talking about one of the most exciting topics in the world, market crashes. Just kidding. We know market crashes are far from exciting, unless you're a masochist. But they are an inevitable part of investing, and it's important to be prepared for them. So grab your popcorn and let's dive into the thrilling world of market crashes. The stock market has a long history of booms and busts, with some crashes having a significant impact on the economy and investors. Here are some of the biggest stock market crashes in US history up to 2022. The crash of Black Tuesday, October 29, 1929. This is perhaps the most well-known stock market crash in US history, as it marked the start of the Great Depression. On Black Tuesday, the stock market lost $14 billion in value, with the Dow Jones Industrial Average falling by over 11%. The crash was caused by a number of factors, including overproduction, a decline in international trade, and speculation on the stock market. The crash of Black Monday, October 19, 1987. This was a global stock market crash that had a particularly large impact on the US stock market. On Black Monday, the Dow Jones Industrial Average fell by 22.6%, the largest single-day drop in its history. The crash was caused by a number of factors, including a slowdown in the global economy, high levels of debt, and concerns about the stability of the stock market. The crash of dot-com bubble, 2000 to 2002. The dot-com bubble was a period of rapid growth and speculation in the stock market, fueled by the rise of the Internet. Many companies that were involved in the Internet saw their stock prices soar, but the bubble eventually burst, leading to a crash in the stock market. The Dow Jones Industrial Average fell by nearly 50% from its peak in March 2000 to its low in October 2002. Financial crisis, 2008–2009. The financial crisis was caused by the collapse of the housing market and the subprime mortgage industry, which led to a credit crisis and a recession. The stock market was heavily impacted by the crisis, with the Dow Jones Industrial Average falling by over 50% from its peak in October 2007 to its low in March 2009. The COVID-19 crash, 2020. The COVID-19 pandemic had a significant impact on the stock market, with the Dow Jones Industrial Average falling by over 30% in just a few weeks in March 2020. The crash was caused by concerns about the economic impact of the pandemic and the measures taken to contain it, such as lockdowns and restrictions on travel. The stock market has since recovered, but the economic impact of the pandemic is still being felt. Are we in another market crash in 2022–2023? In 2022, the stock market experienced another significant crash, with the Dow Jones Industrial Average falling by 13.3%, the S&P 500 falling by 20.3%, and the Nasdaq Composite falling by 30%. The sharp and sudden selling that characterized this market crash was driven by several factors, including high inflation, rising interest rates, and concerns about a potential recession. The tech sector was particularly hard hit, with many tech companies seeing their valuations impacted by higher interest rates. Despite these challenges, the stock market has since recovered, and investors are keeping a close eye on economic indicators as they try to navigate the uncertain economic environment. How to protect your portfolio in a downturn. There are ways to protect yourself during a market downturn, although it may be difficult or impossible to predict a market crash beforehand. Have the right mindset. It is essential to have the appropriate mindset when investing in the stock market, especially if you are a long-term investor saving for retirement. Instead of trying to predict every market downturn, it is important to understand that they are a normal part of investing and will occur periodically. Some people make the mistake of making hasty decisions and end up hindering their own investment efforts. It is crucial to maintain a focus on your long-term goals and not get caught up in short-term market fluctuations. Make regular contributions. By regularly contributing to a workplace retirement plan like a 401k, you can utilize the strategy of dollar-cost averaging, which involves buying more shares when prices are low and fewer shares when prices are high. This approach allows you to take advantage of lower prices during market downturns. Cash can be valuable. If you are concerned about the potential for a market downturn, you may want to consider holding a larger portion of your portfolio in cash as a protective measure. This cash can provide protection as prices fall and give you the opportunity to reinvest at more favorable rates of return. However, it's important to keep in mind that holding too much cash in your portfolio can negatively impact your investment performance over time. Therefore, it's a good idea to invest the cash during market downturns to avoid missing out on potential growth opportunities. Don't invest with borrowed money. Investing with borrowed money can amplify your returns, both positive and negative. However, it can also be risky, especially during a market downturn. While downturns are a normal part of investing and can be recovered from over time, investing with borrowed money can worsen the situation and have a significant negative impact on your net worth. For this reason, it is generally advisable for most investors to avoid opening a margin account. Thanks for sticking around through this rollercoaster ride of a topic. We hope you found some useful information on how to protect yourself during market crashes. And if you enjoyed the ride, don't forget to like and subscribe to our channel. We promise to bring you more exciting topics like taxes, budgeting, and compound interest. Just kidding, we'll try to make those as exciting as possible too. See you in the next one.